Before we dive in, a quick but important note. The information in this presentation is for educational and informational purposes only, and is not intended as financial, legal, or investment advice. I am not a licensed financial advisor, and you should always consult with a qualified professional before making any major financial decisions. This video is designed to simplify complex topics and empower you on your journey, but it is not a substitute for professional guidance tailored to your specific situation. The single biggest financial mistake an American can make isn't picking the wrong stock, buying a flashy car they can't afford, or even a disastrous trip to Vegas. The most devastating mistake, the one that can financially ruin a family for a generation, is signing the wrong mortgage. Think about it. We're talking about a legal contract for hundreds of thousands, sometimes millions of dollars, that will dictate a massive portion of your monthly budget for the next 30 years of your life. Yet, most people spend more time researching their next smartphone than they do understanding the document that controls the roof over their head. This isn't just a hypothetical. I know people who have lost their homes, destroyed their credit, and been set back a decade financially, all because they didn't understand what they were signing. They saw a low monthly payment, got excited about their dream home, and signed on the dotted line, completely oblivious to the ticking time bomb of an adjustable rate, a balloon payment, or a nasty prepayment penalty hidden deep in the fine print. And if you're here, you've probably felt that anxiety. You've been scrolling through Zillow, you've been touring open houses, you've imagined where your couch would go. You can taste it. You're ready. But then you hear the words: PMI, escrow, amortization, debt-to-income ratio, closing costs, points, and your brain just shuts down. It feels like a secret language designed specifically to confuse you, to make you feel powerless in the single most important transaction of your life. Well, that ends today. Right here, right now. The entire purpose of this video is to pull back the curtain, to translate that confusing banker speak into plain, simple English that anyone can understand. By the time you finish watching, you will not be a confused homebuyer. You will be an educated, empowered, and confident future homeowner who can walk into a lender's office and know exactly what's going on. You will have the knowledge to protect yourself, your family, and your financial future. We are going to demystify the American mortgage together. So let's start with the absolute basics. What even is a mortgage? Most people will tell you it's a loan to buy a house. And they're not wrong, but that's dangerously incomplete. A mortgage is not just a loan. A mortgage is a secured loan. That one word, secured, is the most important word in this entire conversation. When you get a personal loan to buy a new laptop, that's usually an unsecured loan. If you stop paying, the bank gets angry, they send collectors after you, they wreck your credit score, but they can't just come into your house and take your laptop back. There's nothing securing the loan. A mortgage is different. The loan is secured by the property itself. The house is the collateral. This means if you stop making your payments, the lender, the bank, has the legal right to take the house back from you. That process is called foreclosure. It's the bank's ultimate insurance policy. They're giving you a colossal amount of money, and in return, you're giving them the keys to your house as a guarantee that you'll pay it back. Sounds scary, and it is, but it's also the fundamental reason why millions of people who don't have $500,000 in cash can still buy a home. The house itself makes the loan possible. So there are three main players in this transaction. First, there's you, the borrower. Second, there's the bank or financial institution, the lender. And third, there's the house itself, the property or the collateral. You want the property, the lender has the money, so you and the lender make a deal called a mortgage. Let's use an analogy. Imagine you want to buy a giant, beautiful $1 million diamond from a jeweler. You don't have $1 million. You have $100,000. So you go to a very rich friend and say, "Hey, can you lend me the $900,000 I need to buy this diamond?" Your rich friend, who is very smart, says, "Sure, but I'm not just going to hand you a briefcase full of cash. Here's the deal. I'll give the $900,000 directly to the jeweler. You'll give the jeweler your $100,000. The jeweler gives you the diamond, but as a condition of my loan, I get to hold on to the diamond in my personal safe. You can wear it on weekends, you can show it off at fancy parties, you can enjoy it, but it stays in my safe. You'll pay me back a certain amount every month for the next 30 years. Once you've paid me back all $900,000, plus a little extra for my trouble, I will give you the diamond, you can put it in your own safe and it's 100% yours. But if you stop paying me, I keep the diamond. Deal. That is, in its simplest form, a mortgage. Your $100,000 is the down payment. Your rich friend is the lender. The $900,000 is the loan amount. The diamond is the house. The agreement to pay it back over 30 years is the loan term. And the little extra for my trouble is the interest. The fact that your friend gets to keep the diamond if you don't pay? That's the secured part. That's foreclosure. Now let's get a little more specific. When you make your monthly mortgage payment, you're not just paying back that loan amount. Your payment is actually a cocktail of 4 different ingredients, and the acronym for it is PITI: principal, interest, taxes, and insurance. You need to burn this into your brain. PITI. First, P is for principal. This is the easy one. This is the actual money you borrowed. If you got a loan for $400,000, the principal is $400,000. Every month, a portion of your payment goes towards chipping away at that principal balance, reducing what you owe. In the beginning of your loan, a very small amount of your payment goes to principal. At the very end, almost all of it does. We'll cover why that is later. Second, I is for interest. This is the bank's profit. This is the fee you pay for the privilege of using their money. It's calculated as a percentage of the loan balance, and this percentage, your interest rate, is arguably the single most important number in your entire mortgage contract. A tiny difference in this number can mean paying tens or even hundreds of thousands of dollars more over the life of the loan. Interest is where the lender makes their money. Third, T is for taxes. This isn't income tax. This is property tax. Every homeowner in America has to pay taxes to their local government, their city, their county, based on the value of their property. This money funds public schools, police departments, fire departments, roads, and so on. Now you might be thinking, why is the bank involved in my property taxes? Great question. Remember, the bank's #1 priority is protecting their investment, your house. If you fail to pay your property taxes, the government can put a lien on your home and, in a worst-case scenario, seize it and sell it to get their money. That would be very, very bad for the bank. So, to make sure that never happens, most lenders require you to pay about 1/12 of your annual property tax billed to them every single month along with your mortgage payment. They put this money aside in a special savings account called an escrow account, and when the tax bill is due, they pay it for you on your behalf. It's forced savings to protect their collateral. Finally, the second I is for insurance. Specifically, homeowners insurance. This is another non-negotiable. Lenders will not give you hundreds of thousands of dollars without proof that the asset is insured against disaster. What if your house burns down in a fire or is destroyed by a tornado? Without insurance, you'd be left with no house, and the bank would be left with a loan for a pile of ashes. They can't repossess a pile of ashes. So, just like with property taxes, they require you to have homeowners insurance. And just like taxes, they usually collect 1/12 of your annual insurance premium every month, put it into that same escrow account, and pay the bill for you when it comes due. So PITI: principal and interest are what you pay to the bank. Taxes and insurance are what you owe to others, but that the bank collects from you as a pass-through to protect their investment. All 4 of these things bundled together make up your total monthly house payment. Now that you understand the fundamental structure, what a mortgage is and what your payment is made of, we can get into the most important part. How is that payment actually calculated? How does the bank decide how much interest you'll pay? And how can you make sure you get the best possible deal, saving yourself a fortune in the process? It all comes down to understanding the different types of mortgages and the mechanics of interest rates. And that is exactly what we're going to break down next. First, let's tackle the biggest fork in the road you'll encounter: the choice between a fixed rate and an adjustable rate mortgage. Think of it like this. A fixed-rate mortgage is a smooth, predictable monorail ride. The track is set, the speed is constant, and you know exactly where you'll end up and when. An adjustable-rate mortgage, or ARM, is more like a roller coaster. It might start off slow and easy, but you know at some point there are going to be some ups and downs, and you're not entirely sure how fast you'll be going. Let's start with the monorail, the fixed-rate mortgage. This is by far the most popular type of home loan in America, and for a good reason. The name says it all. The interest rate is fixed. It's locked in. It will not change for the entire life of your loan, whether that's 15, 20, or 30 years. If you lock in a rate of 6.5% on day 1, you will still be paying 6.5% in your final month, even if market interest rates have soared to 15% by then. The beauty of this is predictability. It's the bedrock of financial planning. Your monthly payment for principal and interest will be the exact same every single month for decades. You'll know your payment in year 27 just as clearly as you know it in month 3. This stability is incredibly reassuring. It allows you to budget with confidence, knowing that your biggest monthly expense is a constant, unchanging number. You can sleep at night, never worrying about a surprise letter from your lender announcing your payment is about to jump. The two most common flavors of fixed-rate loans are the 30-year and the 15-year. The 30-year fixed is the classic American mortgage. It spreads your loan payments out over 3 decades, which results in a lower, more manageable monthly payment. This is what allows many people to afford a home in the first place. The downside? You're paying interest for a very, very long time. The 15-year fixed, on the other hand, is the accelerated version. Your monthly payments will be significantly higher because you're paying the loan back in half the time. But the trade-off is immense. First, you'll almost always get a lower interest rate from the bank for a 15-year loan because their risk is lower. Second, and this is the big one, you will pay a breathtakingly smaller amount of interest over the life of the loan. Let me show you what I mean. Let's imagine a $400,000 loan. With a 30-year fixed mortgage at a 7% interest rate, your monthly principal and interest payment would be about $2,661. Over those 30 years, you would pay the bank a staggering $558,000 in interest alone. That's more than the original loan amount. Now let's look at a 15-year fixed mortgage for that same $400,000, but let's say you get a slightly better rate of 6.5%. Your monthly payment jumps up to about $3,483. That's a big jump, over $800 more per month. But here's the magic. Over those 15 years, you'll only pay about $227,000 in total interest. Let me repeat that. By choosing the 15-year option, you would save over $331,000 in interest. You'd own your home, free and clear, 15 years sooner, and you'd have saved enough money to buy another house in many parts of the country. The choice between them comes down to your personal finances. Can you afford the higher monthly payment now to save a fortune later? Now let's get off the monorail and look at the roller coaster. The adjustable rate mortgage, or ARM. An ARM is a loan where the interest rate can change over time. It's not random. It's tied to a specific financial index that goes up and down with the market. ARMs are seductive because they almost always start with a lower interest rate than fixed-rate loans. This is called the teaser rate or introductory rate. This initial rate is fixed for a set period, typically 3, 5, 7, or 10 years. After that introductory period ends, the adjustable part kicks in, and your rate can change, usually once per year. You'll see these loans advertised with numbers like May 1st ARM or July 1st ARM. It's a simple code. The first number tells you how many years the initial, low interest rate is fixed. The second number tells you how often the rate can change after that initial period is over. So, a 5-to-1 ARM means your rate is fixed for the first 5 years, and then it can adjust once every 1 year for the rest of the loan term. So who in their right mind would take this risk? Well, it can be a smart move for certain people. Imagine you're a young doctor in your residency, and you know you'll be moving to a new city for a permanent job in 4 years. A 5-to-1 ARM could be perfect. You get to enjoy a super low payment for the 4 years you'll be in the house, and you plan to sell the house and pay off the loan long before that first scary rate adjustment ever happens. You get the benefit without taking on the long-term risk. But the risk is very, very real. If you have an ARM and you're still in the house when the adjustment period begins, you are at the mercy of the market. If interest rates have gone up, your monthly payment will go up. If they've gone up a lot, your payment can skyrocket, a phenomenon known as payment shock. This is a huge part of what caused the 2008 financial crisis. Millions of people were lured in by low teaser rates. When those rates adjusted upwards, their payments became unaffordable, leading to a wave of foreclosures that crashed the economy. To prevent a repeat of that disaster, ARMs today have safety features called caps. There's a periodic cap, which limits how much your rate can increase in any single adjustment period, and a lifetime cap, which sets a ceiling on how high your rate can ever go over the life of the loan. These caps offer some protection, but they do not eliminate the risk. Your payment can still increase by hundreds or even thousands of dollars. So we've talked a lot about interest rates, but what are they, really? In the simplest terms, the interest rate is the price you pay to rent the bank's money. It's expressed as a percentage. But there's another, even more important number you need to know. The APR, or annual percentage rate. If the interest rate is the sticker price of the loan, the APR is the total out-the-door price. The APR includes not just the interest rate, but also a bunch of other lender fees and costs associated with getting the loan, like origination fees and discount points. It rolls them all together and expresses them as a single annual percentage. This is critical. You might see 2 lenders offering the same 7% interest rate. But lender A has an APR of 7.15%, and lender B has an APR of 7.45%. This tells you that lender B is charging you more in fees. The APR is the great equalizer. It allows you to make a true, apples-to-apples comparison of different loan offers. When you are shopping for a mortgage, always compare the APR. It reveals the true cost of borrowing money, so you understand the basic loan types, the fundamental choice between the stability of a fixed rate and the potential short-term advantage of an ARM. But what about the loans backed by the government? You've probably heard the letters FHA, VA, USDA. These aren't just acronyms. They are powerful keys that can unlock the door to homeownership for millions, often with shockingly low down payments. But they come with their own unique rules and hidden costs. In the next part, we're going to pull back the curtain on these special government-backed loans and find out if one of them is the secret weapon you've been looking for. So what exactly is this secret weapon? It's a category of loans called government-backed mortgages. Now, the name is a little misleading. When you get one of these loans, you're not borrowing money from Uncle Sam. The government isn't wiring cash into your bank account. Instead, think of the government as the ultimate cosigner. They're not giving the money, but they're telling the bank, hey, if this person can't pay, we've got your back. We'll cover a portion of your loss. This promise, this government guarantee, is like a magic wand for lenders. It drastically reduces their risk. And when a bank's risk goes down, their willingness to lend money goes way up, especially to people who might not fit the perfect 800 credit score, 20% down payment mold that conventional loans often demand. This opens the door to homeownership for millions of Americans. But each of these government programs is designed for a different type of person with its own incredible benefits and, yes, its own hidden costs. Let's pull back that curtain, starting with the most popular one of all, the FHA loan. FHA stands for the Federal Housing Administration. This is the workhorse of the government-backed world. It's the loan that has helped generations of first-time homebuyers get their foot in the door. The headline feature, the thing that gets all the attention, is the incredibly low down payment. With an FHA loan, you can potentially buy a home with as little as 3.5% down. On a $300,000 house, that's a down payment of just $10,500, instead of the $60,000 you'd need for a 20% conventional down payment. For many people, that difference is the entire ball game. It's the difference between buying a home this year or spending 5 more years saving up while home prices continue to climb. FHA loans are also more forgiving on credit scores. While conventional loans often want to see scores in the high 600s or 700s, you can get approved for an FHA loan with a score significantly lower. So what's the catch? Why doesn't everyone just get an FHA loan? This brings us to the hidden cost, and it's a big one: mortgage insurance premium, or MIP. Because you're putting so little money down, the lender and the FHA see you as a higher risk. To offset that risk, they charge you an insurance fee. And with FHA, it's a double whammy. First, there's an upfront mortgage insurance premium, which is a percentage of your total loan amount that gets paid at closing. Most people just roll this cost into their mortgage, so you end up paying interest on it for decades. Second, and this is the crucial part, you'll also pay an annual mortgage insurance premium, which is broken up and added to your monthly mortgage payment. Now you might be thinking, okay, that's just like the PMI on a conventional loan. But here's the multi-$1,000 difference. On a conventional loan, once you reach about 20% equity in your home, you can request to have the PMI removed. Goes away. With an FHA loan, if you put down less than 10%, that monthly mortgage insurance payment is there for the entire life of the loan. 30 years. It never goes away unless you sell the house or refinance into a different type of loan. That monthly fee, which could be hundreds of dollars, will be your constant companion for decades, adding tens of thousands of dollars to the total cost of your home. That is the trade-off. You get into the house with less money down, but you pay for that privilege every single month for a very, very long time. Next up, we have what is arguably the single best mortgage product on the planet, but it's only available to a select group of Americans. We're talking about the VA loan. Guaranteed by the U.S. Department of Veterans Affairs, this is a benefit earned through military service. It's available to active duty service members, veterans, and some surviving spouses. And its main benefit is simply staggering: a 0% down payment. That's not a typo. 0. You can buy a home with absolutely no money down. For the men and women who have served our country, this is an incredibly powerful tool for building wealth and establishing a stable home life after service. On top of the zero down feature, VA loans have another massive advantage. There is no monthly mortgage insurance. None. You get to bypass that expensive monthly fee that FHA and low down payment conventional borrowers have to pay. This can save you hundreds of dollars every month right from the start. So what's the hidden cost here? It's called the VA funding fee. This is a one-time fee paid to the VA to help keep the program running without costing taxpayers. The fee is a percentage of the loan amount, and it varies depending on your branch of service, how much you're putting down, and whether it's your first time using your VA loan benefit. For a first-time user with zero down, it's typically a little over 2% of the loan. Now, you can pay this fee in cash at closing, but almost everyone chooses to roll it into the loan amount. So while it's a cost, it doesn't require cash out of your pocket. And importantly, veterans receiving VA disability compensation are completely exempt from paying the funding fee altogether. When you combine zero down and no monthly mortgage insurance, the VA loan is an unbeatable path to homeownership for those who qualify. Finally, let's talk about the best-kept secret in real estate, the USDA loan. When people hear USDA, the U.S. Department of Agriculture, they think of farms and cows. But the USDA's home loan program is designed to encourage development in rural, and surprisingly, many suburban areas. And the benefits are incredible. Just like a VA loan, a USDA loan offers a 0% down payment option. But unlike a VA loan, you don't need to be a veteran to get one. There are two major catches, though. First, your property has to be located in a USDA-eligible area. And you might be shocked to find out what counts as eligible. We're not just talking about 10-acre farmsteads. Many small towns and the outskirts of suburban areas across the country qualify. There are maps on the USDA website where you can type in an address and see if it's eligible in seconds. Many people who assume they live in the suburbs are surprised to find they're actually in a USDA zone. The second catch is income limits. Unlike FHA or VA loans, the USDA program is designed for low to moderate income households. You can't make too much money and still qualify. These income caps vary by region and family size. So what's the hidden cost? The USDA loan does have mortgage insurance, which they call a guarantee fee. Similar to FHA, it has an upfront portion that's rolled into the loan and an annual fee that's paid monthly. However, the USDA's annual fee is typically lower than the FHA's, meaning your monthly payment will be less. So if you're a person with a moderate income, you don't have a down payment saved up, and you're looking to buy a home just outside the hustle and bustle of a major city, the USDA loan could be your golden ticket. So there you have it. 3 powerful tools, each designed for a different purpose. The FHA loan is the gateway for many, making homeownership accessible with a low down payment, but it comes with the long-term cost of lifetime mortgage insurance. The VA loan is a phenomenal, well-deserved benefit for our nation's service members, offering a true zero-down path without the burden of monthly insurance. And the USDA loan is the surprising dark horse, offering another zero-down option for hardworking families in America's small towns and developing suburbs. Understanding these options is critical. For some, they represent the only viable path to buying a home. For others, they might be a better financial choice than a conventional loan they thought was their only option. But now that we've covered the major types of loans, conventional and government-backed, we need to talk about the fundamental structure of your payment. Because almost every single one of these loans comes in 2 distinct flavors, and choosing the wrong one can be a catastrophic financial mistake. Do you lock in your rate for 30 years and sleep soundly, knowing your payment will never change? Or do you roll the dice on a lower initial rate that could skyrocket later, leaving you with a payment you can no longer afford? The war between fixed-rate and adjustable-rate mortgages is next, and choosing the wrong side could cost you tens, or even hundreds of thousands of dollars. The war between fixed-rate and adjustable-rate mortgages is next, and choosing the wrong side could cost you tens, or even hundreds of thousands of dollars. Imagine you're standing at a crossroads. To your left is a straight, paved road. It's predictable, it's solid, and you can see exactly where it goes. It might not be the most exciting path, but it's safe. To your right is a winding dirt path that starts with a steep, inviting downhill slope. It looks faster, easier, at least at first. But just around the bend, it disappears into a thick, dark forest, and you have no idea if it leads to a cliff, a swamp, or a shortcut to paradise. That, in a nutshell, is the choice between a fixed-rate mortgage and an adjustable-rate mortgage, or ARM. These aren't just 2 different products. They are 2 fundamentally different philosophies about risk, stability, and your financial future. Let's start with that straight, paved road, the fixed-rate mortgage. The name tells you everything you need to know. The interest rate is fixed. It is locked in on the day you sign your loan documents, and it will not change for the entire life of your loan, whether that's 15 years or 30 years. If you lock in a rate of 6.5%, Your rate will be 6.5% on your first payment, and it will be 6.5% on your 360th and final payment 3 decades later. This creates the single most powerful advantage in personal finance: predictability. Your principal and interest payment, the core of your mortgage, will be the exact same number every single month. It is the financial bedrock upon which you can build the rest of your life. You can budget with absolute certainty. You know precisely how much of your paycheck is going to your housing, allowing you to plan for retirement, your kids' college, vacations, and emergencies without ever worrying about a surprise lurking in your mortgage statement. Think of it like this. A fixed-rate mortgage is like finding a gas station that promises to sell you gas for $3 a gallon for the next 30 years. Even if the price of gas across the country skyrockets to $10 a gallon, you still pay your $3. You'd sleep pretty well at night, wouldn't you? That's the peace of mind a fixed-rate mortgage offers. Now, of course, there's a catch. For this incredible stability, you often pay a small premium. The starting interest rate on a fixed-rate mortgage is typically a little bit higher than the initial rate offered on an adjustable-rate mortgage. The bank is taking on all the risk of future rate increases, and they charge you for that insurance policy in the form of a slightly higher rate from day one. And if interest rates plummet after you've locked in, you're stuck with your higher rate, unless you go through the process of refinancing, which is a topic for another day. But for the vast majority of American homeowners, this trade-off is more than worth it. Stability is king. Now let's look at that other path, the one that starts so beautifully downhill: the adjustable rate mortgage, or ARM. The ARM is a chameleon. It changes its colors over time. It lures you in with what's called a teaser rate, an initial interest rate that is often significantly lower than what you'd get on a fixed-rate loan. This is the siren's call of the ARM. That lower initial rate means a lower initial monthly payment, which can feel incredibly tempting. It might even be the difference that allows you to qualify for a larger, more expensive home. But this initial rate is temporary. It only lasts for a fixed period, typically 3, 5, 7, or 10 years. This is where the numbers in an ARM's name come from. If you see something called a 5-to-1 ARM, it means your rate is fixed for the first 5 years, and after that it can adjust once every 1 year. A 7-6 ARM means the rate is fixed for 7 years, then adjusts every 6 months. After that initial period is over, the magic is gone. Your interest rate is no longer fixed. It becomes tied to a specific financial index, like the SOFR, the Secured Overnight Financing Rate. Essentially, your rate will float along with the broader market. If general interest rates go up, your mortgage rate goes up, and so does your monthly payment. If they go down, your rate and payment go down. This is the ticking time bomb. You are trading initial savings for future uncertainty. And this isn't a small risk. Let's go back to that 5-1 ARM. For the first 60 months, life is great. Your payment is low and manageable. But on month 61, you get a letter in the mail. The market has changed. Your new interest rate has jumped 2 full percentage points. Suddenly, your monthly mortgage payment is $400, $500, maybe $600 higher. And it can happen again the next year. And the year after that. Now, to be fair, there are some safety features built in. ARMs have caps. There's an initial cap, which limits how much the rate can jump the very first time it adjusts. There's a periodic cap, which limits how much it can change in each subsequent adjustment period. And there's a lifetime cap, which sets an absolute ceiling on how high your interest rate can ever go. But here's the scary truth. That lifetime cap can be 5 or 6% higher than your starting rate. A 4% teaser rate could potentially balloon to 10%, more than doubling your monthly payment and turning your dream home into a financial nightmare. If this sounds dramatic, it's because the stakes are real. We have a national scar to prove it. In the years leading up to the 2008 financial crisis, ARMs were the weapon of choice. Lenders pushed exotic versions with incredibly low teaser rates that lasted for only a year or two. Millions of Americans were told, "Don't worry about the adjustment. Your home's value will go up so much. You can just refinance into a new loan before the rate ever changes." We all know what happened next. The housing bubble burst. Home values didn't go up, they plummeted. Suddenly, people were underwater, meaning they owed more on their mortgage than their house was worth. They were trapped. They couldn't sell and they couldn't refinance. And then, right on schedule, their adjustable rate mortgages began to adjust. All across the country, families saw their monthly payments skyrocket by unthinkable amounts. People who had been responsible, hard-working homeowners were suddenly faced with a choice: buy groceries or pay the new, inflated mortgage. It was a wave of financial devastation that led to millions of foreclosures and triggered the worst economic collapse since the Great Depression. It was a brutal nationwide lesson on the hidden dangers of the ARM. So, who on earth should ever consider an ARM? The answer is a very small, very specific group of people. If you know with 100% certainty that you will be selling your home before the initial fixed-rate period ends, an ARM might make sense. For example, a military family on a 3-year assignment, or a surgical resident who knows they're moving for a new job in 5 years. In those cases, you can take advantage of the lower initial payment and get out before the risk of adjustment ever kicks in. Others might take an ARM in a very high interest rate environment, gambling that rates will fall significantly before their adjustment, allowing them to refinance into a great fixed-rate loan. But it is always a gamble. For everyone else, for the 95% of American homebuyers who want to put down roots, build a stable life and sleep soundly at night, the fixed-rate mortgage is the undisputed champion. The predictability it offers is priceless. It's the boring choice. And when it comes to the single largest financial decision of your life, boring is beautiful. So you've chosen your weapon, fixed or adjustable. You understand the fundamental risk you're taking on. But what does that monthly payment you're about to sign up for actually consist of? It's not just the loan and the interest. There are 4 hidden components that every homeowner must understand, and they have a clever acronym that makes it easy to remember. Getting this wrong can lead to a surprise bill for thousands of dollars at the end of the year. We're breaking down pity next. Pity. Pity. It sounds like a word you'd say when you feel sorry for someone. And you absolutely will feel pity for your bank account if you don't understand what this acronym stands for, because it represents the 4 fundamental pieces of your total monthly mortgage payment. Most people only think about the first 2. It's the last 2 that can cause financial shockwaves down the road. Let's break it down letter by letter. The P stands for principal. This is the simplest part. The principal is the money you actually borrowed. If you took out a loan for $400,000 to buy your house, your principal is $400,000. Every single month, a portion of your payment goes toward chipping away at this massive number. Think of it like a giant block of marble. Your principal payment is you with a chisel knocking off a small piece. At the beginning of your loan, that piece is tiny, almost like dust. But 30 years later, you've chiseled the entire thing away and you own the statue. This is the part of your payment that builds equity. It's the part that's actually buying your house. It's your money, paying yourself back in the form of home ownership. Next comes the first I. This I stands for interest. This is the bank's favorite letter. Interest is the fee you pay to the lender for the privilege of using their money. It's their profit. It's the cost of the loan. When you get a mortgage, you're not just paying back the $400,000 you borrowed, you're paying it back plus interest. Now here's the critical part that trips everyone up. In the early years of your loan, the vast majority of your monthly payment is devoured by interest. Remember that amortization schedule we talked about? In your first month, you might make a payment of, say, $2,500. But only $500 of that might go to your principal, to your marble block. The other $2,000? That's pure interest. It's a payment straight to the bank. It has nothing to build your equity. Feels a little painful, and it should. But as the years go by, the balance shifts. Slowly, then more quickly, more of your payment goes to principal and less goes to interest until in the final years you're basically just paying off the principal. The first 2 letters, P and I, principal and interest, are the core of your loan itself. This is the part that's directly tied to the money you borrowed from the bank. But your monthly payment doesn't stop there. And this is where the danger and the confusion comes in. This is where we get the surprise bills. To understand the next 2 letters, we first have to understand a crucial concept called an escrow account. Think of an escrow account as a separate little savings account that your mortgage lender manages for you. It's like a forced savings plan. You're not allowed to touch it. Every month, when you make your one big mortgage payment, the bank schemes a little off the top and deposits it into this escrow account. They're not doing this out of the kindness of their hearts. They're doing it to protect their investment, which is your house. They want to make absolutely sure 2 very important bills get paid on time every single year. These 2 bills are the T and the second I in pity. The T stands for taxes, specifically property taxes. When you own a piece of land and a house, you have to pay taxes to your local government, your city, your county, your state. This money pays for public schools, for the fire department to show up if your house is burning down, for police, for road maintenance, for public libraries. It's your contribution to the community you live in. Property taxes are not optional. And if you don't pay them, the government can eventually take your house. The bank knows this. They have a massive financial stake in your house, so they can't risk you forgetting to pay your property tax bill. So instead of you having to save up all year and write a giant check to the county for, say, $6,000, the bank does it for you. They estimate your annual property tax bill, divide it by 12, and add that amount to your monthly mortgage payment. So, in our example, that's $500 a month. That $500 goes directly from your main payment into your escrow account. It just sits there collecting until the tax bill is due. Then, the bank pays it on your behalf automatically. It's convenient, but it also hides the true cost. And here's the kicker. Property taxes can and often do go up. Your home's value increases, or your local government needs more funding. When that happens, your lender recalculates and suddenly your monthly mortgage payment jumps up even if you have a fixed interest rate. This is the #1 cause of payment shock for new homeowners. Finally, we have the second I. This I stands for insurance. Specifically, homeowners insurance. This is another non-negotiable. Your lender will not give you hundreds of thousands of dollars without proof that the asset, your house, is protected. Homeowners insurance covers you against disasters. A fire, a tornado, a tree falling through your roof, a major theft. If your house burns to the ground, the insurance company will pay to rebuild it. This protects you, but more importantly for the bank, it protects them. They need to know that their collateral won't just disappear into a pile of ash. Just like with property taxes, the lender doesn't trust you to remember to pay this bill. So they estimate your annual insurance premium. Let's say it's $1,200 for the year. They divide that by 12, which is $100 a month. They add that to your monthly payment, and it gets funneled right into that same escrow account alongside your tax money. When your insurance premium is due, the bank pays it for you directly from the escrow account. And just like taxes, insurance rates can also change. If you make a claim, or if the risk of natural disasters in your area goes up, your premium can increase, causing your total monthly PITI payment to rise. So let's put it all together. PITI, principal, interest, taxes, and insurance. Your monthly payment is not one thing. It's a bundle of 4 different things, all packaged together for convenience. Part of it pays down your loan and builds your equity, principal. Part of it pays the bank for the loan, interest. And the other 2 parts go into a holding account, escrow, to pay your future bills for you, taxes and insurance. Understanding this is the key to avoiding that dreaded end-of-year surprise. If your taxes or insurance go up more than the bank expected, your escrow account will have a shortfall. The bank will cover it, but then they'll send you a letter demanding you pay them back, and they'll increase your monthly payment for the next year to make sure it doesn't happen again. By understanding PITI, you're no longer a passive passenger. You're an informed driver who understands every component of the financial vehicle you're operating. But what if I told you there's a 5th phantom letter that can sometimes attach itself to your mortgage payment? A secret second I that doesn't build equity, doesn't protect your house from disaster, and doesn't fund your local schools. It's an expense that only protects the bank, yet you're the one forced to pay for it, potentially for years, costing you tens of thousands of dollars. It's called private mortgage insurance, or PMI. And in the next part, we're going to expose what it is, and more importantly, how to get rid of it. So what exactly is this insurance that you pay for, but that only protects the bank? Think of it this way. Imagine you walk into a high-end electronics store to buy the latest, most expensive TV. You don't have all the cash, so the store offers you a payment plan. But because you're only putting a little money down, the store manager is nervous. He says, "Listen, I'll give you the TV, but you have to pay for a security guard to stand outside your house and make sure nothing happens to my TV until you've paid it off." You think that's insane, right? You're paying a salary for a guard who works for the store, not for you. That is exactly what private mortgage insurance, or PMI, is. It is a security guard for the bank's money, and you are paying their salary every single month. PMI is an insurance policy that protects your lender in case you stop making your mortgage payments and go into foreclosure. It exists for one reason: the bank sees you as a higher risk. Historically, the magic number in the mortgage world is a 20% down payment. If you put down 20% or more, the bank feels secure. They believe you have significant skin in the game, making you far less likely to walk away from the property. Plus, that 20% equity acts as a massive financial cushion for them. If you default and they have to sell your house, the home's value could drop by 10 or even 15%, and they'd still get all their money back. But when you put down less than 20%, say 5% or 3.5%, that cushion disappears. The bank is now exposed to much more risk. If you default early on and home prices have dipped, they could lose a substantial amount of money. So, to approve your loan, they make a deal. They say, "We'll give you the loan, but you have to pay for this extra insurance policy. PMI? That will pay us back if you default." You don't get to shop around for it. You don't get to choose the provider. The lender sets it up and you just pay the bill. And it is not cheap. PMI typically costs between 0.5% to 2% of your original loan amount per year. Let's make that real. On a $400,000 loan, 1% PMI is $4,000 a year. That's an extra $333 tacked onto your mortgage payment every single month. $333 that builds you zero equity. It doesn't pay down your loan. It doesn't go towards your taxes or your homeowner's insurance. It is purely a fee you pay for the privilege of having a low down payment. It's like setting money on fire month after month. The good news is you are not stuck with it forever. Getting rid of PMI is one of the most powerful financial moves a homeowner can make, and there are several ways to do it. The first way is the slow and steady passive route: automatic termination. Thanks to a federal law called the Homeowners Protection Act, your lender is legally required to automatically cancel your PMI on the date your loan balance is scheduled to reach 78% of the original value of your home. The key words there are scheduled and original value. This is based on your initial amortization schedule, assuming you make every single payment on time without paying any extra. It's the safety net. It will happen eventually, but you can do much better. The second and faster way is to be proactive and request cancellation. The same law gives you the right to ask your lender to drop PMI once your loan balance reaches 80% of the home's original value. Notice the difference. You can request it at 80% while they are forced to do it at 78%. Getting there a year or two earlier could save you thousands of dollars. To do this, you need to have a good payment history, be current on your loan, and submit a written request to your loan servicer. It's a simple letter that can put a lot of money back in your pocket. But the third strategy, this is the game changer. This is the one that can save you tens of thousands of dollars and shave years off your PMI payments. Both of the first two methods are based on the original value of your home, what you paid for it on day one. But what happens if your home's value goes up? Let's run the numbers. Say you bought a house for $400,000 with a 5% down payment of $20,000. Your loan is for $380,000. You are deep in PMI territory. You make your payments for 3 years, and maybe your loan balance is now down to $365,000. Based on the original value, you're still nowhere near the 80% mark. But let's say during those 3 years, the housing market in your neighborhood got hot. Your neighbor sold their house for way more than they expected. Your little $400,000 house is now worth $500,000. This changes everything. Your new loan-to-value ratio isn't based on the old price anymore. It's your current loan balance divided by the new market value. So, $365,000 divided by $500,000 is 73%. You are now well below the 80% threshold required to cancel PMI. You can contact your lender and state that you believe your home's appreciation has given you more than 20% equity. They will require you to prove it, which usually means paying for a new independent appraisal, which might cost $500 or $600. But paying $600 one time to stop paying $333 every single month is one of the best returns on investment you will ever find. This single strategy has saved American homeowners billions of dollars. A fourth option is to refinance your entire mortgage. If your home has appreciated in value, you can apply for a brand new loan. If that new loan is for 80% or less of the home's current appraised value, your new mortgage will not have PMI. This is a bigger step as it involves closing costs and a whole new loan application, but it can be a fantastic option if you can also lock in a lower interest rate at the same time. Now, a critical warning. Not all mortgage insurance is the same. What we've been discussing applies to conventional loans. If you have a government-backed loan like an FHA loan, the rules are completely different and frankly much harsher. FHA loans have their own form of mortgage insurance called a mortgage insurance premium, or MIP. And for most FHA loans taken out in the last decade, if you put down less than 10%, you are required to pay that MIP for the entire life of the loan. It never drops off. Not at 80%, not at 78%, not ever. The only way to get rid of FHA mortgage insurance is to refinance out of the FHA loan and into a conventional loan. This is a brutal gotcha that traps millions of homeowners into paying thousands of extra dollars. And it's something you have to know. On the flip side, VA loans for veterans and active service members are the gold standard here. They are one of the few loan types that allow for a zero down payment without requiring any monthly mortgage insurance at all. It is one of the best financial benefits offered to those who have served the country. So, PMI is the bank's bodyguard that you're forced to pay for. It's a fee that can feel like a penalty for not having a huge down payment. But it is not a life sentence. You now know the secret to shedding one of the most expensive and misunderstood costs of a mortgage by paying attention to your loan balance and, more importantly, your home's true market value. We've now covered the 5 core components of a typical mortgage payment: the principal that builds your ownership, the interest that pays the bank, the property taxes for your community, the homeowner's insurance to protect your asset, and the private mortgage insurance to protect the lender. These 5 pieces, often abbreviated PITI, make up that one big payment you send every month. But where does that money actually go? How much of your very first payment is just pure interest, and how much actually goes toward owning your home? The answer is shocking. In the next part, we're going to pull back the curtain on your monthly payment, break down the amortization schedule, and reveal the mathematical truth about how little you own in the beginning, and the simple strategy you can use to change that equation in your favor. So let's pull back that curtain. Your monthly mortgage payment, the number you'll see leave your bank account every single month for decades, isn't just one thing. It's actually 4 things bundled together into one convenient and often intimidating package. The pros call it PITI. It stands for principal, interest, taxes, and insurance. Think of it like a pizza with 4 different slices, and in the beginning, the slices are definitely not equal. Let's start with the first slice: principal. This is the good stuff. This is the only part of your payment that is actually paying for your house. It's the portion that chips away at that massive loan balance you took out. Every dollar of principal you pay increases your ownership stake, your equity. It's you buying your home one tiny piece at a time. In the grand scheme of your payment, especially at the start, this is a surprisingly small slice of the pizza. Now for the second and initially the biggest slice, interest. This is the bank's profit. It's the fee you pay for the privilege of borrowing hundreds of thousands of dollars. You're essentially renting money, and the interest is the monthly rent. For the first several years of your loan, this slice is enormous. It dominates your payment. It's the reason why, even after paying thousands of dollars, your loan balance barely seems to budge. The bank always gets paid first, and they do it by front-loading the interest. The third slice is taxes, specifically property taxes. This money doesn't go to the bank at all. It goes to your local government, your city, your county, your school district. It pays for roads, firefighters, public schools, and libraries. Now, you could pay this in a big lump sum to the government once or twice a year, but most lenders don't want to risk you forgetting. So they do it for you. They estimate your annual property tax bill, divide it by 12, and add that amount to your monthly mortgage payment. They then put this money into a special savings account called an escrow account. When the tax bill is due, the bank pays it on your behalf from that account. It's a forced savings plan for your taxes. And that brings us to the final slice, insurance. Homeowner's insurance. This is non-negotiable. The bank is lending you a massive amount of money secured by this one asset, your house. They need to know that if it burns down or gets hit by a tornado, their investment is protected. Just like with taxes, the lender will usually collect your homeowner's insurance premiums every month as part of your PITI payment, stick it in that same escrow account, and pay the annual bill for you when it comes due. Protects their investment, and thankfully it also protects yours. So that's PITI. Principal, interest, taxes, and insurance. But understanding the ingredients is one thing. Understanding the recipe, how they're mixed together over time, is the real secret. And for that, we need to look at the bank's secret playbook, the amortization schedule. Amortization is just a fancy word for paying off a debt over time in equal installments. The schedule is a giant spreadsheet that shows you every single payment you will make over the life of the loan. All 360 of them for a 30-year mortgage. It breaks down, for each payment, exactly how much is going to principal and how much is going to interest. And when you see it for the first time, it is truly shocking. Let's use a real-world example. Say you get a $400,000 mortgage at a 6.5% interest rate for 30 years. Your monthly payment for just the principal and interest part, we'll leave taxes and insurance out for a moment to keep it simple, is about $2,528. Now let's look at payment number 1. You proudly write that check for $2,528. You feel like a homeowner. But what did you actually buy? The amortization schedule tells the truth. Of that payment, a staggering $2,167 goes straight to interest. That's the bank's profit. Only $361 actually goes to principal, to paying down your loan. Let me say that again. You paid over $2,500, but you only own about $360 more of your house than you did the month before. That is the brutal reality of front-loaded interest. The bank structures the loan so they get the majority of their profit in the early years. Let's fast forward. What about 5 years in? You've made 60 payments. You have paid the bank a total of $151,680. You'd think you'd have made a serious dent in that $400,000 loan, right? Wrong. Your remaining balance is still over $377,000. After 5 years and over $150,000 in payments, you've only paid off about 5.5% of your loan. The vast majority of your money went to interest. This is why it feels like you're spinning your wheels for the first decade. The scale is heavily tilted in the bank's favor. It's not until around year 17 that the scale finally tips, and more of your payment starts going to principal than to interest. By the time you get to your last few payments, the reverse is true. Payment number 350 might see over $2,400 go to principal, and less than $100 go to interest. Seeing this schedule can feel demoralizing. It can feel like you're trapped in a 30-year financial prison. But here's the secret. The amortization schedule isn't a sentence. It's a default setting, and you have the power to change it. You have a strategy you can use to fight back against front-loaded interest and change the equation in your favor. And it is remarkably simple. Pay more than you have to. Specifically, make extra payments that go directly toward your principal. Every extra dollar you pay toward principal is a dollar that the bank can never charge you interest on ever again. It doesn't just reduce your debt. It fundamentally alters the amortization schedule itself. It short-circuits the timeline. Think about it. That first payment, where only $361 went to principal. If you had sent in an extra $100 and clearly marked it as for principal only, your loan balance would have dropped by $461 instead. Now, the next month, the bank calculates the interest based on a slightly smaller balance. It's a tiny difference at first, but this effect snowballs month after month, year after year. So how do you do this in practice? There are a few powerful methods. First, there's the bi-weekly payment plan. Some people set this up where they pay half their mortgage every 2 weeks. Since there are 52 weeks in a year, this results in 26 half payments, which equals 13 full monthly payments. That one extra payment per year goes entirely to principal. But you don't need a fancy plan to do this. A simpler way is to just take your monthly payment, divide it by 12, and add that amount to your payment each month. On our $2,528 payment, that's an extra $211 a month. By doing just that, you would pay off your 30-year mortgage in about 23 years, saving you over $120,000 in interest. 7 years of your life and the price of a luxury car just by adding a couple $100 a month. A second, even easier method is the round-up strategy. If your payment is $2,528, just round it up and pay an even $2,600 or $2,700 every month. That extra $72 or $172 might not feel like much, but it adds up to thousands in savings and shaves years off your loan. Finally, there's the windfall method. Get a bonus at work? A tax refund? Instead of buying a new TV, make a one-time lump sum payment directly to your principal. A single extra $5,000 payment in your first year could save you over $15,000 in interest and get you out of debt nearly a year sooner. There is one critical, non-negotiable rule here. Whenever you send extra money, you must specify that the extra funds are to be applied directly to principal. If you don't, the bank's computer system might just assume you're paying next month's bill early, and it won't have the same interest-destroying effect. You can write it on the memo line of a check, or select the option when paying online. Be explicit. Understanding this isn't just about numbers. It's about control. It's about shifting the power dynamic from the bank back to you. The 30-year mortgage is designed for the bank's comfort, not yours. But with a little bit of knowledge and discipline, you can take their 30-year plan and turn it into your 22-year plan, or your 18-year plan, saving yourself a fortune in the process. So you understand your monthly payment, you have a strategy to beat the bank at their own game. But before you even make that first payment, there's one final mountain to climb. A mysterious pile of fees known as closing costs. In the next part, we're demystifying every single line item, showing you what's negotiable, and revealing the hidden fees that can cost you thousands if you're not paying attention. Alright, you've navigated the pre-approval, found the perfect home, and your loan is in the final stages of underwriting. You feel like you're at the finish line, and then a document lands in your inbox. It's called the loan estimate, and as you scroll down, your jaw hits the floor. You see a number labeled estimated closing costs. That's thousands, or even tens of thousands of dollars. It feels like getting a restaurant bill where they charged you for the napkins, the silverware, and the chair you sat in. What is all this stuff? And do you really have to pay it? Welcome to the final boss battle of getting a mortgage. Closing costs. This is, without a doubt, one of the most confusing and intimidating parts of the entire process. But here's the secret. It's not just a random pile of fees. It's a series of specific charges for specific services, and understanding them is your superpower. It's the difference between blindly paying whatever is put in front of you and taking control of the biggest financial transaction of your life. Let's break this mountain down into 3 smaller, more manageable hills. Your closing costs can be split into 3 main categories: lender fees, third-party fees, and prepaids. First up, lender fees. Think of these as the bank's service charges. This is how the lender makes money for the work of creating, processing, and funding your loan. The biggest one you'll see is the origination fee. This is essentially a commission paid to the lender for doing the deal. It's often calculated as a percentage of the loan amount, usually somewhere between 0.5% and 1%. On a $400,000 loan, that's $2,000 to $4,000 right there. You might also see things like an application fee, a processing fee, or an underwriting fee. Sometimes these are bundled into the origination fee. Other times they're listed separately. This is the cost for the army of people in the back office who verify your income, check your credit, and make sure the loan meets all the guidelines. Now, here's the multi-$1,000 tip. Lender fees are often negotiable. This is where you have leverage. When you get a loan estimate, you are not locked in. You can and should shop that estimate around. If you take lender A's estimate to lender B, and they offer you a lower origination fee or waive the application fee, you can go back to lender A and ask them to match it. They want your business, and they'd often rather cut their profit margin than lose you entirely. Never be afraid to ask, is this fee negotiable? The worst they can say is no. Another item you'll see in this category is discount points. This is a tricky one. Points are a form of prepaid interest. You're essentially paying a fee up front to buy down your interest rate for the life of the loan. 1 point typically costs 1% of the loan amount and might lower your rate by, say, 0.25%. This can be a good deal if you plan to stay in the home for a very long time, but you have to do the math. Calculate your monthly savings from the lower rate and see how many months it would take to recoup the upfront cost of the points. If your break-even point is 10 years but you only plan to live there for 7, you're losing money. Okay, that's the first hill. Now for the second, third-party fees. These are fees for services that are required to get the loan, but they're not paid to your lender. The lender is just coordinating them for you. The first is the appraisal fee. We talked about this before. An independent appraiser has to assess the home's value to make sure the bank isn't lending you more money than the house is actually worth. You pay for this service, typically a few $100s. Next, the credit report fee. The lender needs to pull your credit history from the 3 major bureaus: Equifax, Experian, and TransUnion. This is usually a small fee, maybe $30 to $50. Then comes the big one, title services and title insurance. This is critically important and often misunderstood. When you buy a house, you're buying the title to the property, which is the legal right to own it. A title company does a deep dive search into the property's history to make sure the seller actually has the right to sell it to you, and that there are no hidden claims, liens from unpaid contractors, or long-lost heirs who could show up and claim your house. After the search, you buy 2 title insurance policies. The first is a lender's policy, which is mandatory. This protects the lender's investment in case a title issue is discovered down the road. The second is an owner's policy, which is technically optional, but you should absolutely 100% get it. This protects you. If that long-lost heir does crawl out of the woodwork 5 years from now with a valid claim, your owner's title insurance policy is what saves you from a catastrophic legal battle and potentially losing your home. It's a one-time fee paid at closing that protects you for as long as you own the property. Here's another power user tip. While the lender will recommend a title company, you are legally allowed to shop for your own. Title insurance premiums can vary by hundreds of dollars, so it pays to make a few phone calls. Other third-party fees you might see include a survey fee to verify property lines, a flood certification fee to determine if the property is in a flood zone, and various government recording charges, which are the fees your local county charges to officially record the sale and make you the legal owner. Finally, there are attorney or settlement fees which go to the professional who orchestrates the closing, handles all the paperwork, and makes sure the money goes to the right places. Now for our third and final hill, which is often the most confusing, prepaids and escrow. Here's the most important thing to understand about this section. This is not a fee. This is your money that you're prepaying for future expenses. First, you'll have to prepay for your homeowner's insurance. Most lenders require you to pay for the entire first year's policy upfront at closing. Second, you'll prepay some property taxes. Depending on when property taxes are due in your area, and when you close, you'll need to put a certain number of months' worth of taxes into an account to get it started. This account is called an escrow account or sometimes an impound account. Think of it as a savings account managed by your lender. Every month, a portion of your mortgage payment, in addition to the principal and interest, will go into this escrow account. Then, when your property tax and homeowner's insurance bills are due each year, the lender pays them for you out of this account. It's a brilliant system, actually. It prevents you from being hit with a massive multi-thousand-dollar tax bill once a year and ensures the bills that protect the lender's investment always get paid on time. The final prepaid item is prepaid interest. Your first mortgage payment is usually due on the first of the month, after the month you close in. So if you close on May 10th, your first payment isn't until July 1st. But interest on your loan started accruing the second you signed the papers on May 10th. So at closing, you have to pay the interest for the remaining days of that month, from May 10th to May 31st. This is a one-time charge. A little trick here. If you close at the very end of the month, you'll have less prepaid interest to pay at closing. So you have lender fees, third-party fees, and prepaids. How do you keep track of it all? The law is on your side. Within 3 days of applying for a loan, your lender must give you that official loan estimate we talked about. This is their best guess of your final costs. Then, at least 3 business days before your closing date, you will receive a second, more important document, the closing disclosure. This is the final bill. Your job is to take these 2 documents and compare them line by line. By law, some fees, like the lender's origination charge, cannot increase at all from the estimate to the final disclosure. Other fees, like for third-party services the lender recommends, can't increase by more than 10%. And some, like your prepaid insurance, can change by any amount because the lender has no control over them. If you see a fee that has jumped significantly or a new fee you don't recognize, you must call your loan officer immediately and ask for an explanation. This 3-day window is your last chance to catch errors and dispute charges. Don't be afraid to question everything. This is your money, and you have a right to know exactly where every single dollar is going. Conquering closing costs is about transforming confusion into clarity. By breaking down the fees, knowing what's negotiable, what you can shop for, and how to scrutinize your final documents, you've taken back control. You're no longer just signing on the dotted line. You're making informed, powerful decisions. Now that the money is all accounted for, it's time for the moment of truth. The final walkthrough and the closing table itself. What really happens in that room? What are the dozens of documents you're about to sign? And which ones hold the most power over your future? The final steps are here, and in our next part, we'll walk you through every signature, every handshake, and the incredible moment you finally get the keys. You're standing at a conference table. In front of you is a stack of paper so thick it could stop a door. Your hand is already starting to cramp just looking at it. This is the moment of truth. This is closing day. For weeks, maybe months, this has all been theoretical, numbers on a screen, emails from your loan officer, conversations with your realtor. But now it's real. It's 100 pages of legally binding ink and paper that stand between you and the keys to your new home. So, what are you actually signing? And which of these documents truly holds the power? Before you even sit down at that table, there's one final critical step, the final walkthrough. This isn't a formality. It's your last line of defense. You walk through the empty rooms of the house one last time, not as a visitor, but as the imminent owner. You're checking to make sure the seller completed the agreed-upon repairs. You're confirming that the fancy refrigerator and the custom window blinds you negotiated for are still there. You're making sure a pipe didn't burst overnight. You are ensuring that the property you are about to legally bind yourself to for the next 30 years is in the exact condition you expect it to be. If something is wrong, you do not proceed to closing until it is resolved. This is your last point of leverage. Once the walkthrough is complete, you head to the closing. It's usually held at a title company, an escrow office, or an attorney's office. In the room with you will be a closing agent or attorney, a neutral third party whose job is to facilitate the signing and ensure all the money and documents go to the right places. Your real estate agent will likely be there, and sometimes the sellers are there too, ready to sign their side of the deal. The closing agent will slide that daunting stack of paper in front of you. But here's the secret. You don't need to be an expert on all 100 pages. You only need to deeply understand 4 of them. These are the 4 horsemen of your home loan, the documents that define your entire financial future. The first and most important document you'll review is the closing disclosure, or CD. Remember the loan estimate you received at the very beginning? The closing disclosure is its final locked-in twin. You are legally required to receive this document at least 3 business days before closing. This is your chance to review all the final figures without pressure. It is the final receipt for the biggest purchase of your life. You'll see the final loan amount, your interest rate, your exact monthly payment including taxes and insurance, and a detailed breakdown of all the closing costs. The most important number on this entire form is at the bottom of page 1. Cash to close. This is the exact dollar amount you need to bring to the table. You will compare this document line by line to your loan estimate. The numbers should be identical or very, very close. If there are any major discrepancies, you stop everything and ask why. This document is your financial shield. Next up is the promissory note. If the closing disclosure is the receipt, the promissory note is the IOU. This document is your personal, legally binding promise to repay the loan. It's shockingly simple, usually just a few pages long, but it's the most powerful document you will sign. It states the total amount you're borrowing, the interest rate you'll pay, the dates your payments are due, and where to send them. It also clearly spells out the penalties for failing to pay. When you sign this, you are personally guaranteeing the debt. Even if you lose the house, the debt detailed in this note can in some states still follow you. This is the promise. But what gives that promise teeth? That's the third document. The mortgage, or in some states, the deed of trust. People use the word mortgage to describe the whole loan, but in reality, this specific document is the security instrument. It's the or else. The promissory note is your promise to pay. The mortgage is the document that says, and if I don't pay, the lender has the right to take my house through foreclosure. It connects the debt from the promissory note directly to your property. It's the bank's collateral. It's what makes the loan secured. You're not just promising to pay. You're pledging your home as the guarantee. This is the document that gives the lender the ultimate power. After signing the documents that indebt you for 30 years, you finally get to the one that makes it all worthwhile. The deed. This is the championship trophy. The deed is the legal document that officially transfers ownership of the property from the seller to you. It will have a legal description of the property. Not just the street address, but the specific lot, block, and plat map information that uniquely identifies your piece of land on Earth. When the seller signs this and you accept it, ownership has legally changed hands. You are now the owner of record. As you're signing, you'll also be dealing with the money. That cash to close figure from your closing disclosure needs to be paid. You can't just write a personal check for $50,000. The funds need to be guaranteed. This means you'll almost always need a cashier's check from your bank, or more commonly, you'll have arranged a wire transfer ahead of time. You'll hand over the check or provide the wire confirmation, and that money goes into an escrow account, managed by the closing agent. The agent then acts like a financial air traffic controller, making sure your down payment and the lender's loan money are combined and paid out to the seller, the old lender, the real estate agents, the appraiser, and anyone else who is owed a fee. Now comes the signature marathon. You will sign your name over and over and over again. You'll sign the CD, the note, the mortgage. You'll sign disclosure saying you understand you could lose your home, that you know your loan might be sold, that you're not a terrorist. Your signature becomes a repeating echo, each one a small hammer blow forging the legal chains of the agreement. Initial here, sign here, date here. Can feel robotic, but never forget the weight of what you're doing. And then you wait. Just because you've signed doesn't mean it's over. 2 critical things need to happen behind the scenes. First, the loan needs to fund. The closing agent notifies your lender that you've signed everything. The lender then reviews the key documents and, if everything is perfect, they release the money via wire transfer to the closing agent. This can take a few minutes or a few hours. Second, the deed and the mortgage need to be recorded. The closing agent sends a courier to the county recorder's office. The new deed with your name on it is officially filed in the public record, telling the world that you are the new owner. At the same time, the mortgage is recorded, telling the world that your lender has a legal claim, a lien on your new property. In some states, you can't get the keys until the county confirms the recording is complete, which could even be the next day. But in many cases, once the lender confirms the loan has funded, the deal is considered done. And then, after the final phone call is made, after the wire confirmation comes through, after your hand is sore and your mind is swimming in legal jargon, it happens. Someone, your agent, the closing agent, maybe even the seller, slides a small metallic object across the table. It's a key. It feels impossibly light, impossibly simple for what it represents. This isn't just a piece of cut metal. It's the key to your front door. It's the key to late-night movies in your own living room, to painting a wall whatever color you want, to planting a tree in your own yard. It's the key to a new chapter of your life, a chapter you just bought with a mountain of paper and a single powerful promise. You have the keys. You've moved in. The boxes are unpacked. But the journey isn't over. In fact, the real 30-year marathon has just begun. What happens when you get a letter saying your loan has been sold to a company you've never heard of? What is an escrow analysis, and why does your monthly payment suddenly go up? And most importantly, how can you attack the principal on this massive debt and pay it off years, even decades ahead of schedule? The final, most important secrets to truly mastering your mortgage are coming next. The letter arrives on a Tuesday. It looks official, boring even. You almost toss it in the recycling bin. But you open it and your heart sinks. The notice from your mortgage servicer is clear. Your monthly payment is going up. Not by a little. By $100, maybe $200 a month. Panic sets in. You signed a fixed-rate mortgage. You locked in your payment for 30 years. How is this possible? Is it a scam? A mistake? Welcome to the single most confusing and frustrating moment for millions of American homeowners. The escrow surprise. This is the answer to that nagging question of how a fixed payment can suddenly change. Remember that pitty acronym? Principal, interest, taxes, and insurance. While your principal and interest are locked in, your taxes and insurance are not. They live in the real world, a world where costs go up. Your local government might raise property taxes to fund new schools. Your insurance company might raise premiums after a season of bad storms in your region. Your lender doesn't pay these bills out of the kindness of their heart. They pay them from your escrow account, that special savings account they forced you to set up. Each month, a piece of your mortgage payment goes into this escrow bucket. The lender estimates how much you'll need for the whole year for taxes and insurance, divides it by 12, and adds it to your P&I payment. But here's the catch. It's just an estimate. So when your property taxes go up by $600 for the year, and your insurance goes up by another $600, that's an extra $1,200 the lender has to pay on your behalf. Your escrow account is now running a deficit. It's short. So the lender does two things. First, they have to make up for last year's shortage. They might give you the option to pay it in a lump sum, or more commonly, they'll spread that shortage amount over your next 12 payments. Second, they have to adjust your monthly escrow deposit for the coming year to reflect the new, higher costs. The combination of paying back the old shortage and funding the new, higher future payments is what causes that sudden, painful jump in your monthly bill. It's not a conspiracy. It's just bad math catching up with reality. Now you can and should call your servicer to understand the exact breakdown. You can even shop for cheaper homeowners insurance or, though it's much harder, appeal your property tax assessment. But this is all defensive. It's reacting to the lender's agenda. The real power, the secret to mastering this massive debt, isn't about playing defense. It's about going on offense. It's about attacking the one number on your statement that truly matters, the principal balance. Every mortgage statement you get is a battlefield report. It shows you the total payment you made, and then it breaks down where the money went. In the early years, it's a horror show. You might send in $2,000, and see that a staggering $1,500 of it was devoured by interest, with only $500 chipping away at the actual loan balance. The loan balance is the enemy. The interest is its lifeblood. To win this war, you must starve the beast. You must cut off the interest by killing the principal. And here's the beautiful, simple secret. Any money you pay above your required monthly payment can be directed to go 100% towards the principal. It doesn't get split. The interest has already been calculated for that month. Every extra dollar is a precision strike on the heart of your debt. This is the key that unlocks everything. So how do you do it? The first strategy is the simplest and most powerful. It's often sold as a confusing bi-weekly payment plan, by third-party companies who charge you a fee for the privilege. Ignore them. You can do this yourself for free. Simply take your monthly mortgage payment, divide it by 12, and add that amount to your payment every single month. For example, if your payment is $2,400, 1/12 of that is $200. By paying $2,600 every month instead of $2,400, you are painlessly making one extra full mortgage payment over the course of the year. What does that one extra payment do? It doesn't sound like much, but the effect is earth-shattering. On a typical 30-year, $500,000 mortgage, this simple strategy alone could slice nearly 5 years off your loan and save you over $80,000 in interest. You just bought back 5 years of your life and the cost of a luxury car for the price of a couple hundred extra bucks a month. You are using the bank's own amortization schedule against them. Each extra payment reduces the principal, which means the next month's interest is calculated on a smaller balance, meaning more of your regular payment goes to principal, creating a snowball of debt destruction. The second strategy is the windfall attack. This is for those moments you get a little extra cash. A bonus at work, a tax refund, a side hustle payment. The temptation is to buy a new TV or go on vacation. But imagine taking that $3,000 tax refund and making a one-time principal-only payment. The instant you do that, you have permanently eliminated all the future interest that $3,000 would have accrued for the next 20-something years. It's like planting a money tree, but in reverse. You're not growing money. You're annihilating future debt. It's one of the most powerful and satisfying financial moves you can ever make. And this leads to a more advanced but brilliant third strategy. Let's say you do this for a few years. You make your 1/12 extra payments, you throw your bonuses at the principal, and you've knocked a significant $70,000 or $80,000 off your balance. Your monthly payment is still the same as it was on day one, which is great because you're paying the loan off faster. But what if you need more cash flow now? What if one spouse wants to stay home with the kids? Or you want to free up money to invest? You can ask your lender about a mortgage recast. This is not a refinance. You don't change your interest rate, you don't get a new loan, you don't pay thousands in closing costs. For a small administrative fee, usually just a few $100s, the lender will take your new, lower principal balance and re-amortize it over the remaining term of your loan. The result? Your monthly payment drops, sometimes significantly. You've effectively taken all your hard work in paying down the principal and converted it into immediate monthly cash flow, without extending the life of your loan. It's a financial masterstroke that most people have never even heard of. This is the ultimate mindset shift. Your mortgage is not a 30-year prison sentence. It is a financial tool and you are in control. That monthly statement is not a bill. It's a report card on your journey to freedom. The American dream isn't just about owning a home. That's just the first step. The real dream is owning it outright. It's about the day you make that final payment and the bank sends you the deed, free and clear. It's about knowing that the roof over your head is yours, and no one can ever take it away. It's about freeing up thousands of dollars a month to invest, to travel, to be generous, to build generational wealth, to retire not when the government says you can, but when you decide you're ready. Paying off your mortgage early is the single biggest financial step you can take to accelerate your path to true financial independence. It transforms your biggest liability into your greatest asset, and in doing so, it transforms your life. It all starts with understanding that you hold the power. You can stay on the bank's 30-year plan, or you can create your own. The choice is yours.